Welcome back to our In the Pages series with Monte Jackel. We're focusing on his article, The Hopefully Upcoming 2025 Tax Reform Debate. Now, if you haven't already done so, please make sure you check out the other videos in this series. Closely associated with partnership taxation is a matter of aggregate versus entities. We ask whether a particular business venture should be construed for tax purpose as a singular entity as opposed to a constructive assembly of multiple entities and aggregation. Of course, that can lead to very different tax outcomes. What, in your opinion, needs to be done there? The Treasury has these abusive entity rules that are already out there. Do we need more?
Well, this proposal that I'm just putting out there for discussion has to do with there really is no comprehensive set of principles that are administrable that spell out under what circumstances you apply aggregate principles to partnerships or entity principles to partnerships. It's not clear whether aggregate principles means actual ownership and applying various provisions of the Internal Revenue Code, like whether you are treated as owning an asset owned by the partnership or just get attributed the tax attributes, or when you sell a partnership interest, whether you're treated as selling the underlying asset versus selling a partnership interest. There are provisions in the code dealing with what the character of the gain or loss would be. But the fundamental issue of whether you have actual ownership because you're applying aggregate principles is deriving from statements made primarily first in the 1954 legislative history to the code, and then in 84 again. And it's really founded on statements that were made in the legislative history that had no foundation in a statute enacted by Congress. Despite that, meaning the conference report in 1954 said that you can apply aggregate principles or entity as appropriate under the circumstances. There was no statute accompanying that statement. And yet multiple courts, as recently as the Rawat, if I'm pronouncing it right, R-A-W-A-T, a case illustrated, many courts have taken the position that when you apply aggregate principles, it means you actually own the underlying asset that you're focusing on in the partnership. And there's a very good position that those courts are all wrong. And that, but you got a lot of precedent already where the courts are wrong. And so now the question is, do you just leave it alone? Do you apply some statutory mechanism to provide rules, regulations that set forth certain parameters for when you would apply aggregate and entity, which you could do? There could be a statute saying, yeah, it's treated as aggregate is treated as actual ownership or not. It could set forth results under based on existing authorities, if it was agreed that was the right answer, and then set forth factors for future cases. At least something could be tried to be done to fix it. And the problem with 701-2E, which is a rule that it's called in the regs or referred to as the abusive entity rule, it's really, that's just a one-sided rule. I mean, it was written as an anti-abuse rule, but it's not dependent on there being any abuse. It's just the government thinks that aggregate principles should apply, which is the usual posture for the government. And then the taxpayer comes back and says, no, the statute clearly contemplates entity treatment, and the tax results are clearly contemplated. there's a number of cases where the taxpayer could counter that aggregate assertion by the government are almost zero. There would be some, but very few. And there were some of us who argued when the 701-2 reg was issued that the 701-2E should be even-handed for both taxpayer and the IRS, and that's what it should be.
Your last item concerns grantor trusts. This is a hot topic in the tax community. Should the owner of a trust be considered the owner of the individual assets of the trust? What if we end up getting economic transactions between the grantor and the trust itself? When do you disregard them? When do you not? What's your thinking there in terms of possible tax reform for 2025?
Well, the issue for the grantor trust has always been whether the grantor of the grantor trust is treated as actually owning the asset for federal income tax purposes, or under 671 and the regulations they're under, just attributed, the taxpayer owner is just attributed the tax items. And translated, that means, can you do a separate transaction with the trust, like sell property to the trust and so on? And much to the disappointment or enjoyment, depending upon which side you're on, of the current state of affairs, it's not clear from the statute 671 following or the underlying regulations in 671 what that grantor trust status really means. In a lot of cases on this side or that side of it, but it's not clearly set forth. And then the government comes out in 1985, issues a revenue ruling, 85-13, that said that for all federal income tax purposes, the grantor is the owner of the assets in the trust. And then that becomes the foundation for a position taken in the regs under 1.1001-2 that treats a cessation of grantor trust status as a disposition for federal income tax purposes. Again, saying that the grantor is the owner of the asset for federal income tax purposes until the grantor trust ceases. And then you have issues relating to, well, for federal, state, and gift tax purposes, you do a transaction. If you do a transaction with a grantor trust, it's still a transaction. It needs to be taken into account. And the complexities are so mind-boggling that's why, as I mentioned earlier, Rev. 2023-2 on the whether you get a stepped-up basis for property in the irrevocable trust that was not included in the gross estate, which the answer in the ruling was you don't get a stepped-up basis. But left out of the ruling, because otherwise you have to deal with these tough issues or liabilities in excess of basis at death. And what do you do about a case where there's been a transaction that's engaged in between the trust and the grantor? Point is, you need some like a statute, at least a minimum statute that authorizes regs, and unless it sets forth the rule itself, as to whether grantor status is just actual ownership, or is it just attributing tax items? Or do you give the Treasury the authority to decide it in case-by-case type of situation? It needs to be something, because there's a lot of money going down, escaping the net by not answering that fundamental question. And enough should be enough. Now, there have been some proposals that fail every time so far to fix the issue. But in fairness to those who advocate for a change in the law from the revenue ruling, it's just that the law is just unclear, and you're never going to get an answer to it without some standards to apply. After all these years, It's still unclear. And as I was saying before, the proposals get defeated as soon as they're teed up. I mean, they get dropped because there's a constituency, even within the party, proposing the changes, not to do the changes because it pisses off the small business community or et cetera. And those things then just stops it cold. So again, if they're going to do fundamental tax reform, they need a stiff spine, or at least stiffer than the one that currently exists. And, somehow, although some people, when I say this, they react adversely, the 86 Tax Reform Act was somehow they got everyone together to at least get something done that was comprehensive. Why can't it get done again? But it's going to require, not reacting and so negatively to being criticized for proposing something that's good for the overall tax system.
That's it for this part of the discussion. Please keep an eye out for the next part of this series with Monte Jackel. Goodbye, and thanks for watching. Want more like this? Subscribe for more tax videos. Special thanks to our executive producers, Jasper Smith and Paige Jones, showrunner and video editor, Jordan Parrish, and assistant video editor, Chris Trigo.